Great. Well, great to see everyone, and we are going to dive in. I guess first, before we get rolling, if everyone could give just a very quick background on themselves and the firm.
Sure, happy to. Thanks for having us. Antoine Lorto, I'm a partner at Part Square Capital. I joined the firm about 20 years ago. We manage just short of 20 billion, focused on three main strategies: subordinated debt, large cap senior lending, and middle market direct lending.
Hi, my name is Volkan Kurtaş. I'm the founder of Vibrant Capital Partners. We are focused on credit and structured credit based out of New York. We opened our international office in Abu Dhabi 3.5 years ago. This is my fourth time in a row participating in this conference, and it's a pleasure to see how it's grown.
Good afternoon, Loïc Ferry, founder, CEO, and co-CIO of Shonavari Investment Manager. 6 billion of assets focused exclusively on the continuum of credit and private credit in European markets. Office in Abu Dhabi as well, and been coming to the region and delighted to have quite a few significant LPs in the region.
Hi, my name is Rick Miller. I'm the CIO of private credit at TCW. TCW is a $200 billion asset management firm in the States with a global footprint, primarily focused on debt, both public and private. I run the private credit business, which covers really three strategies: premium spread strategy, a more opportunistic strategy, and a partnership with PNC Bank.
And I'm Richard Grimm, head of global credit at Cambridge Associates. Cambridge has been active in the region for multiple decades. We're an investment manager and advisor to institutional investors and family offices with about 600 billion of AUM. Before we really dive in, I was going to frame out, I think, the markets in general, and then dive into liquid credit and private credit. At Cambridge, we produce a lot of interesting data, and my colleagues do this. And one of the things that I think is noteworthy is if you look at not just the U.S. equity markets, but developed markets in general, going back to the 70s, on a price to cyclically adjusted cash earnings, you're at the 100th percentile for the U.S., and you're at the 85th percentile for domestic markets in general. So we're certainly in a risk-on environment on the equity side. If you look at liquid credit, fixed income, across the board, U.S., Europe, IG, U.S., Europe, high yield, a lot of ABS markets, you're within the 10th percentile of tightest spreads. So we're in a pretty interesting spot in the markets in general. So now if we pivot into what we're going to talk about today, which is fundamentally sub-investment grade credit and private credit, I wanted to start with the fear factor. And I think the fear factor is real. We've all read about it over the last few months. A lot of the coverage has been misguided. But as we just heard on the last panel, and we just caught the tail end of it, I think there's real concern amongst regulators and people really trying to get under the hood a little bit. So maybe if we dive in, and Loïc and Volkan, I wanted to start with you two, more on the CLO side of things and leveraged loan side of things. We're at a point in the market, really, when you look at the 30-year history of the broadly syndicated loan market, that a lot of practitioners would say it's the lowest quality within the market that we've seen. Obviously, you both have generated strong returns over a long period of time. How are you navigating that market today?
Yeah, I mean, I would say I wouldn't agree that it's lowest quality, but it's definitely stretched. It's definitely on the low side. Especially leverage picked up in the broadly syndicated market, and spreads are extremely tight. As you know, if you look at this high yield market, about 1.5 trillion is high yield bonds, 1.5 trillion is broadly syndicated loans, that much private credit, one-third split. On the broadly syndicated side, almost 75-80% goes to CLOs. And there has been tremendous demand to CLO product because the product proved itself over the last 20 years that it performs through the cycles. So CLOs have tremendous appetite to broadly syndicated loans, which is continuing to tighten the market. Over 70% is priced above par. Last time I saw that was 2019 December, right. Almost priced to perfection. Of course, I do think you have to be, especially in this kind of environment, extremely careful with your credit underwriting. Manager performance is very dispersed. But overall broadly syndicated market, I do not see systemic risks there. I think it will perform. One issue that people should be aware of is liability management and activities that borrowers do, which will negatively affect the recoveries in the broadly syndicated market. When I look at private credit market, which we'll talk about, I think I have other concerns.
Yep.
But maybe I pass to Loic.
Yeah, thank you. So, as you said, Richard, I think the divide between the public tradable markets in credit and let's say private side of the market is actually interesting. At the end of the day, I mean, we all, whether you invest in private credit or in credit, you're exposed to the same type of deterioration of credit qualities and delinquencies and so on. And what I would say is clearly there's been significant pickup on different parts of the market. And the fear factor, you could say, okay, well, we are on the high percentage of the default cycle on, depending on the asset class. Obviously, if you talk about corporates or if you talk about consumer or if you talk about mortgages, we'll talk maybe later about the difference between those things. But what I feel is that what most people forget is that credit is one part of the capital structure which is senior to equity. You have equity market trading at near all-time high in terms of P's and so on. And it's great to ask the question about credit, but let's not forget that credit is senior to equity. That's the first thing that people forget. The second thing is that credit is all about fundamentals. We can talk about analytics, we can talk about stress tests and so on. I mean, at the end of the day, we need to understand each and every layer of the fundamentals that underline the credit portfolios. Once you've said that, there are still very attractive parts in capital structures of different structured credit products, whether it's CLOs, ABS, and so on. And it's all about risk-adjusted return. At the end of the day, you can have a tranche inside the capital structure at one given point in time that looks very attractive. And 6 months later, the same tranche is going to be much less attractive because spread compressed, risk picked up, or whatever. So it's extremely important to not be too generic and to not forget that credit is above equities in the capital structure.
Yeah, no, I think that's a fair point, Loic, and that's also why I tried to frame out the conversation. I think we can all take a little bit more of a negative lens as to where spreads are today and some of these sorts of trends, but that is, you're reflecting on the asset class itself. So vis-a-vis 2 years ago, obviously, you're not getting as rewarded, but to your point, still interesting risk reward. So then pivoting more into the private credit side of things, and I'll turn to Rick and Antoine. Some of the obvious things that people are focused on, which I think truly are, from a beta perspective, canaries in the coal mine. PIK is a percentage of total interest income. The fact that covenant light is the majority of the BSL market. It's an increasing part of the direct lending market. So some of those things that people are concerned about, again, how are you guys navigating that today and maybe address that? Start with you, Antoine.
So we are starting to see the lines get a bit more blurred between the broadly syndicated loan markets and the private credit markets. That's especially true in the US. In Europe, we're seeing I think more of a separation between both. We think Europe actually has sort of structural benefits, structural advantages, which work quite well with private credit. To start with, the supply-demand imbalance that we're talking about quite generally doesn't quite apply in the same way in Europe. There's less exposure to BDC capital having raised in Europe. Issuance in Europe has actually increased relative to last year. Structurally speaking as well, in Europe, you're going to typically have more loan-style documentation, so documentation which isn't directly picked up from a high-yield type culture. You have things like monthly reporting, which are quite rare in a US context. And a third thing, which is perhaps a bit more intangible, is if you're investing in a European leader, typically the moats and the barriers to entry that you will have as a company will be greater than those of an American business. When a growing American company can access the entire domestic US market, whereas in Europe, you can be very good in France, but then if you want to be good in Germany, you need to start over. And all this red tape we talk about Europe from a credit standpoint actually creates this inertia, which we view as a very positive from a credit standpoint.
And I think to your point, it's structural, right? So
structural.
that's not changing.
No.
People can talk about uniform insolvency regimes, and in reality, you're not getting there. So it's a pretty different market to the U.S. I guess, Rick, I'll then pivot to you, focused in the U.S., but obviously the way you've approached the strategy, you're not on the flow end of the upper end of the spectrum within direct lending. So maybe touch on that a little bit in terms of how you're navigating today's market. As you alluded to, you have multiple strategies.
Well, I think it's pretty clear to all of us now that the halo around private credit is probably gone. The bloom is off the rose. There's more negative press. We've heard words like canary in the coal mine, cockroaches, and other terms that describe the state of private credit. I think what you're really seeing, Richard, is maybe the end of the beta trade in the asset class in the States, where really post-GFC, I'm not sure you could have picked a more benign investment climate to invest in. Low interest rates, no recessions, no defaults, rising enterprise value multiples. Not a bad climate in which to lend, invest equity, real estate. I mean, all asset classes did well. I think a lot of us probably looked smarter than we really are over that time period. Over the last 3, 4, 5 years, that's over, right? Rates are not high, they're normal. Volatility in the economy is normal. The business cycle, the return of a business cycle is normal. And I think you're going to see that manager selection is going to be a big point of dispersion or differentiation amongst returns for investors, where it really hadn't been. And it pains me to say this, but I'm not sure it mattered so much in the post-GFC period. And now it will. What worked over the last 14 or 15 years isn't necessarily going to be the same recipe for success. You want to have a manager that's been around for a little bit, more than maybe just post-GFC, and has seen a recession or a cycle or a different capital market environment. You're going to want to have access to differentiated origination. And maybe most importantly, a manager that can manage underperforming investments, mistakes. I think you're going to see more of that. The opportunity for that is going to be there. That presents opportunities as an investor. But I think the big message here isn't private credit's over. It's not going away. It's been around forever. It's going to be around forever. And who provides it's changed. But as an asset class, what's changed is the beta part of this trade is over. And I think it's now manager selection above all else.
Yeah. No, I think, Loic, did you want to add something?
I just wanted to add a word about, obviously, generically speaking, we define private credit as typically corporate private credit, right? And
Right.
there's a very vast asset class, which is specialty finance and asset-based lending. And in that space, I think contrary to the corporate space where there's, a lot of supply now, and the demand is still there, but obviously on that space, you have a significant way for growing because, let's not forget that private credit was started as a bank replacement strategy, right? Because banks had regulatory capital issues and basically there were things they were less able to do. And so basically it obviously started with the biggest bulk of the bank, which is like single names and corporates. But, when you look at consumer, when you look at residential mortgages, you look at all sort of auto loans and granular pool of assets. I mean, that asset class in private credit offers definitely great value today. For two reasons. You have granular pools with predictability of cash flow, which actually you find in any securitized product on the liquid side. And also because that's the only part of private credit where you can truly observe the premium of the illiquidity. You're basically investing in an illiquid asset class, but you can monetize that in the public market through securitization. and that's an observable premium. And that, we can see over time, and at the moment, this is actually standing at a very good level. So from a relative value standpoint.
Yeah, no, I think Loic, you're touching on an important point. Really at its core, private credit is an amalgamation of strategies that have been around for decades. Even direct lending, goes back to the 90s. It was just different platforms. I think the issue and the concern people have is just how fast and how quickly things have grown. And I think whenever that happens, it's inevitable that there will be groups that participate in that market that aren't following best practices. And so I think maybe if we pivot there a little bit and just talk about, addressing the fear and some of the concerns, and some of it, is legit if we're in a late cycle part of the market, just in terms of return compression potential and whatnot. But really the opportunity to differentiate yourselves within the private credit market. Antoine, you touched on already, your lens from Europe and what that means, and maybe if you want to elaborate a little bit more.
I think we've been in such a benign environment from a credit standpoint over the last decade or so that it feels like you've got managers out there who seem to have forgotten some of the fundamentals. And if you take, incentives, Charlie Munger used to always say, show me the incentives and I'll tell you the outcome. And the incentives of many of these managers is to deploy capital. It's not to generate performance. And if you combine an incentive to deploy into the market, the end result is that you'll be investing in cyclical sectors, cyclical businesses, over-levered capital structures, weak documentation, all the things that you should be quite wary of as a credit investor. On the other hand, if you stick to the fundamentals, which Loic alluded to, which is cash flow-based lending, really understanding the businesses, stable and predictable companies with strong barriers to entry, you should be able to navigate very well through a lot of this noise. And I think it comes back to a point that Rick was making, which is the dispersion in managers. You've got managers that will continue to consistently deliver high quality returns in the credit space by not trying to reinvent the wheel and just stay very focused on what they've been doing for a very long period of time.
Yeah, I think I agree with Loic and Antoine as well. At the end of the day, we shouldn't forget it's one economy, one real true economy. How corporations finance themselves with public credit or private credit is a secondary matter. The economy has to perform. So as credit analysts, we need to keep our eyes on the fundamentals and our underwriting standards. For instance, I just saw that First Brand's default, which spooked everybody. Mm-hmm. I think there's about 120 active broadly syndicated CLO managers. 102 of them also had exposure to First Brands. We had 0, to Tricolor 0, because we take it very seriously, the fundamental underwriting, when we look at the credit. So that's like keeping your eyes on the ball. Liability side can be adjusted and changes over time, but the fundamentals of the company and the economy is important. About private credit, I want to say a few things. Of course, it's grown very fast, and lack of transparency in the pricing of the loans. Recently, this PIK loans, the canary in the coal mine story, etc., started worrying investors. It created a fear factor. And I think it's important because, for instance, First Brand was not a private credit loan,
right?
But it defaulted, and everybody on the private credit space is, oh, what's going on, right? I think that's because, like, when you look at the broadly syndicated market, these are bigger loans, broader syndication, and they trade every day. So you can see the loan at par, 1 month later at 98, 3 months later at 80. It's not going well. Whereas in the private credit market, that's not available. That data is not available to people. So it's going par, and we have seen cases in 2 weeks it went to 10 cents, 20 cents. So I think that creates the scare. We can discuss if it's justified or not, but I can understand the investor bases why they are. Because if you are getting news, even if it's bad news, it's news. If you are not getting any news, any data, that creates this fear factor.
I think that when you look at the trends in the marketplace, the advantages of the senior secured place in the capital structure as an investment instrument is pretty vast. You're top of the capital structure, your first lien, you have floating rate debt, Those are all very unique and built-in hedges, advantages. It's why it's a safe harbor asset class, or supposed to be a safe harbor asset class. And over the years, we've watched a lot of those protections get diluted, right? We've seen the rise in debt to EBITDA ratios. We've seen the movement to a more heavily adjusted, poorly vetted EBITDA definition. We've seen the movement to covenant light. That's more of a BSL attribute coming down in the private credit. And that's created this landscape of which you're now seeing some of this behavior get punished, right? Shortcuts, lack of protections in loan docs, and that creates fear. I think you have to return to what the value proposition is of the asset class as an investor, as an allocator of capital, and why you're attracted to it, and why that, as I said earlier, the manager selection is going to be so important. But you've got the ability to step in and take advantage of the opportunities that are going to come out of this environment, right? Opportunistic is going to create an environment, this environment is going to create opportunities for an opportunistic strategy, distressed, providing liquidity to those in need. That's historically been a great avenue to generate great returns. And maybe finally, to end on a more positive note, when you're an investor in fixed, in the top of the capital structure here, you're trying to isolate your risks. You don't want to take enterprise value risk that's out of your control. You'd like not to take, documentation risk or dilution of your protections risk. So you're removing those. You don't want to be surprised that base rates go up, like we saw back in 22, and have your balance sheet no longer functional. I think you're coming upon a period where the new vintage strategies from private credit have an opportunity to do very well. And I say that because you're no longer going to be surprised by interest base rates going up. They're up. They're not high. They're normal. They're off the zero bound. That was the anomaly. I think you can expect that you're going to be investing in a climate where enterprise value multiples are no longer climbing, to the moon or climbing to the sky. They're moderating. So you're eliminating two of these risks, and you're kind of isolating to the one risk you need to take, which is the economy, the underlying economy. And you're supposed to live with that risk in this asset class because of all those built-in protections you have as a lender.
Yeah, and I think what you're touching on again is, this isn't a monolithic market. Even within direct lending, as we talked about, Antoine, geographically, there's differences.
Pockets of value.
Borrower size, there's differences. Business model, there's differences, right? If you're on the flow end of the market, you're getting a grid, it's going out to, how many competitors. That feels more like the syndicated loan market. But if you're not playing in that space, you're getting monthly financials, you're getting liquidity covenants, you're getting all these things. So I think that sometimes gets lost in the mix here as well. I know we're starting to run a little bit short on time. Rick, you started to go there. So I wanted to pivot off of, most of this discussion has been around corporate cash flow lending. What are the opportunities that are coming out of this environment, coming out of the 2019, 2021 vintage company that financed themselves with a lot of leverage, with a certain growth profile that may or may not have actually occurred, but didn't hedge their interest rate risk. So any excess cash flow was servicing debt. What are you seeing today? Antoine, Park Square from its origins was a mezz lender.
Indeed. So our DNA is one of a junior capital investor. The opportunities we're seeing, I'd say, are coming from potentially two areas. One, good companies, bad capital structures. A lot of what we were describing is exactly that. And as as things unravel, there's potentially going to be an opportunity to go back into these companies and make attractive investments. Another point we didn't really touch upon is this decorrelation between liquid pools of capital and illiquid assets. That as well, if you combine with exposure to a lot of retail investors, could also precipitate an environment where there could be quite a lot of value from an outside-in perspective, looking to acquire a lot of those loans for sellers or people who are trying to grapple to whatever liquidity is left.
Yeah, and I think you're touching on, to us, that's one of the real big questions today around the market.
It's a fundamental question.
That's the structural
and an
question.
important question for investors, I think.
Conscious of time, yeah, go.
Yeah,
go
I'm
ahead,
seeing
Volker.
that large portions of EBITDA is getting used to pay interest these days, right? The interest stayed a little higher for a while, so I do expect the credit cycle to turn in the next 2 years. That will reflect a volatile BSL market, and with this fear factor involved, that can become a really bumpy ride on the private credit market. I mean, these different credit cohorts are present in these markets, more triple C and B minuses in the private credit, a little higher quality in BSL. I would expect lower recovery rates in the BSL markets, maybe more defaults in the private credit market. Opportunities I see predominantly in a well-performing structured credit market. CLO double Bs and triple Bs over 25 years, they performed extremely well. What I see from my personal expertise is I think I might end up restructuring some private credit CLOs in 2 years. And in those restructurings, there's tremendous value. Like,
Yeah, I think, at the end of the day, we like those environments. We thrive in those environments. And, to deliver a high double-digit return over a very long period of time, you actually need to benefit from those environments. And so one thing I think we haven't touched, I mean, obviously the big opportunity is the relative value, understanding the relative value and going deep in the relative value, not forgetting the fundamentals. And what's going to be key is that you are talking about manager selection. Obviously, track record is one. Wide understanding of the market environment is second. But third is data. Antoine was talking about the heterogeneity of Europe. And I think to some extent, those are barriers to entry. And you want to be in areas where there are barriers to entry. You want to be in area where you're going to exploit value because it's very more complicated to get the data, to understand the data. And so as investor, we invest across, obviously, QSIPs, securities, ABS, CLOs, secondary, primary. We invest in specialty finance loans, and we invest in asset-backed loans. We're also very active with banks' balance sheet on the SRT side and so on. All this is giving us a sum of data that someone that is just in one of those buckets doesn't have. And I think that's really the hedge. And we really think that that's what you want from a manager today.
Yeah.
I think the positive or the thing to look for, the opportunity set is you need a manager that can embrace, not manage through, but embrace volatility. It's coming both in the markets as well as in the economy. You're seeing it expose some behaviors amongst managers that maybe wasn't recognized or wasn't punished because of the environment we were in, now get punished simply because the environment changed. So I think you want that experience, you want that capability, and you want that investment discipline that they can move around, and whether it's providing liquidity in that opportunistic avenue, or it's providing fresh capital into healthy operating businesses. But you want a consistent approach from a manager that you can look back at their body of work and say, they've done it before, they're doing it now, they'll do it in the future, because what we can't control is what happens in the future. And that's, in fact, where all this volatility awaits us.
Right.
And so we want to be able to manage it and embrace it, not fear it.
Yeah.
Yeah, COVID was the time where my company made most of money. So when things get volatile, I think experts start making better.
Yeah, and I think that's the takeaway. We have to wrap there, but I think, it's a broad asset class. Dispersion isn't a negative. It can be a positive. It can lead to other opportunities. And certainly from my seat, and I think it's clear from the panel seat, there's strength in the asset class. And even if we go through a cycle, I think opportunity. So again, we'll leave it there. And thank you for everyone for attending.
Thank you.
Thank you.
Thank you.